Okay, hi everyone. Welcome to the Advanced Mortgage Solutions podcast. This is a podcast where Scott Miller from Advanced Mortgage Solutions assists people on their property journey. Whether you're a first-time buyer, a seasoned investor, we cover all topics. My name's Joel Sadler, and as I mentioned today, our guest and expert is Scott Miller, who's the owner and founder of Advanced Mortgage Solutions. Now, Scott has been a property investor for over 20 years and has a professional background in logistics, management and finance. And obviously for the last 17 plus years has been working in the mortgage space. So he's a wealth of information. As we know, knowledge is power. So Scott, welcome today.
What questions do you have for me today?
Well, we had some really good feedback around, we touched on deposits, particularly for first home buyers and, how much they need to get into a home and that sort of thing. So we thought, well, let's tease that out a bit more because you're such a wealth of knowledge, Do you want to run us through deposit options that are available for people? And then we can sort of deep dive into some of those questions further as we go.
Okay. Yep.
Yeah.
So look, for first home buyers, there is a specific product made available by the government and it's available through KiwiSaver. And they have contracted that out to about 5 main banks out there. So that would be Westpac, Kiwibank, SBS, TSB, and the Co-op Bank. Now, there are some smaller options out there that also have access to the first home loan through KiwiSaver or the building societies. Some of the bigger building societies also have access to that product. But what we find is usually the banks have a little bit more horsepower than the building societies, so we tend to stick to them. Cashback and discounts seem to be a little bit freer with the mainstream banks. And that allows applicants to buy a house with as little as a 5% deposit. When we go directly to a bank, so Joel, your bank is, let's just say ANZ, for example, then ANZ and all the other mainstream banks, when they don't use the KiwiSaver or a first home loan, they require a 10% deposit as a minimum. So, and then anything more than that is a bonus. I will say right now that if you have a 20% deposit, it does ensure that you can sort of go to any lender you like. Any lender will say, hey, come this way, we'd like your business. The discounts are as good as they're going to be with a 20% deposit. There's usually the removal of any kind of bank fees. The cashback's as good as it's going to be. So the 20% is the real gold standard of getting everything that you possibly can from a lender. And to the point where it wouldn't matter if you came to me with a 50% deposit or a 20% deposit, I could get you exactly the same. So that 20% is a magic line. But to come back into, not every first home buyer has the 20%, and that's the key. There's several ways you can get to 20%, but let's cover that off in a moment. Really, the further you're away from having a 20% deposit, the more expensive the mortgage is going to be in the repayments because something called lender's mortgage insurance is added to the payment. So there's a law in New Zealand that are placed upon the banks to say, hey, if you become aware that there's less than a 20% deposit, then you have to insure the mortgage. Now, the insurance is for the lender, not for the punter, but the punter pays for the insurance. Sounds a bit unfair, doesn't it? But that's just the way it works. And that's why you find that if you only have a 5% deposit, for example, then, the lender's mortgage insurance can be up to sort of 1.2% of the loan total, of the interest rate that's charged. An extra 1.2% can be added to it. When you've got a 10% deposit, that goes down to 0.75 added to the interest rate. When you've got a 15% deposit, it drops to 0.25 of 1%. And obviously, when you have a 20% deposit or more, there's no additional loading on the interest rate because there's no requirement for any lender when there's a 20% deposit to have lender's mortgage insurance.
Right. Yeah. Okay, that makes sense. And does this whole lender's mortgage insurance come about after the financial crisis back in 2018 or something like that to help protect the banks from
you would think so,
kind of thing? Or?
No, look, I've been doing this for just over 20 years, so a little bit more than that.
20 years,
Yeah.
Awesome.
And lender's mortgage insurance was a thing when I was cutting my teeth many, many years ago as a mortgage advisor. So it's not something that's come about through GFCs, global financial crisis, or anything like that. It's always been something. So yeah, beyond my knowledge of why it's there, but it's always been there.
Yeah. Okay. So it sounds like that, ultimate, home loan deposit amounts, that 20%, as you're saying, opens a lot of doors and a lot of options to you.
Yeah.
And then you mentioned, obviously, there were a few options there for those with less than 20%. Is there any further nuances to that, less than 20% side of things you could brief us on?
Look, there's a few more expenses when you have less than a 20% deposit, and it usually comes in the guise that the lender's going to ask for a registered valuation to be completed. Because there's a higher risk that's perceived by the lender by having less than a 20% deposit, they absolutely want to make sure that the value of the house is either more or equal to what you paid for that house. So most lenders will then say, hey, on top of the normal criteria that we'd ask for, we need to pay for a registered valuation to ensure that we're not paying too much for that house when you've only got a 5, a 10, a 15% deposit. And the unfortunate part of that is that, they range from about $800 through to about $1,200, depending on the value of the house. And of course, at that time, especially as a first home buyer, it's an unwelcome expense, but it's sort of essential and it's part of it. It's most of the time we just can't get around the need for that registered valuation. So again, outwardly it seems to hurt the people that you're trying to help the most, and that are finding it hardest to get into the first home buyer space. But it just does pay to be aware of those extra little things that come along when you don't have a 20% deposit. Ways to get to 20% deposit, quite interesting though, if you want. How about we just jump into that?
That'd be great.
So obviously the advent of KiwiSaver has been an absolute godsend in regards to first home buyers. Up to that point, you were really just waiting on savings or, your parents to help you out, or even worse, maybe for your parents to pass before you took over the family home. Those days are fairly well gone. We don't have to wait for that kind of event to happen. But the KiwiSaver's been absolutely fantastic. And for your first home, you can use your KiwiSaver, obviously. If you've owned before but didn't use your KiwiSaver, then you can get a second chance to use your KiwiSaver. But if you've bought a house before with your KiwiSaver and it's a second time round, say, I don't know, you split up from a partner or something horrible like that, because you used your KiwiSaver the first time, you cannot use your KiwiSaver the second time, even though you can approach getting an aura for a second chance. The second chance just illustrates that you're in the position of a first home buyer. It doesn't actually mean that you get another access to your KiwiSaver a second time. And there's quite a lot of misconception around that out there in the market. Savings is obviously one that you don't have to do a lot of explanation. So usually most first home buyers have a little bit of money and quite a lot of KiwiSaver. Sometimes they have a lot of money in KiwiSaver. So, it just depends on the individual. And sometimes that also becomes a different story with age. So someone's in their early 20s is likely to have less savings than someone might be in their mid-30s, for example. And that can change the sort of approach that we make to a lender. And then we come to family assistance, and this is where it really does get quite helpful. There's two different types of family assistance. One is just a simple gift, and that means that the parents or a sibling or a family member is going to give you some money to help you with your deposit funds to get into a house. What that means is it can be used and added towards your deposit. There's no obligation at all by the person that's giving the gift. They're simply saying, hey, as a family member, I'm happy to help you out. Here goes some money, and I don't expect it to be paid back. The second option is equity within a house of a parent or a sibling, again, a family member, that is willing to give up a wee bit of their equity to help you get to your 20% to buy your own home. There's a small obligation there now, so the people that are giving up that wee bit of equity to assist their kids or whoever in the first home buying space, they become a guarantor for the little bits that's required to get to that 20% deposit. So there's a little bit more involved than just a simple gift.
Okay.
So that's the first home buyer space. I mean, if you've got things, and I think you mentioned this last time, can you use gold or crypto or another asset to secure mortgage against them. In very early days, that used to be a thing, but I think, in the late 80s, there was a stock market crash where a lot of people had taken equity out of their house to buy shares, and that went horribly wrong because the world came to an end financially in the late 80s sort of thing. So they pulled back on that kind of asset lend. So you would actually have to sort of transfer that back into a cash type of, swap it for its equal amount in whatever gold or crypto or whatever you're trying to sell was worth, including, some people will sell, an extra car or a car that they were doing up, being a classic car or something like that to help them with their deposit funds. And that's quite okay to do that. That's fine.
Yeah.
Then we move on to people who are, say, they've already got their first home, but they want to buy their second home. And there's something out there that used to be called a bridging loan. That's not so much a thing anymore. In 2017, the Responsible Lending Act said that at the time of application, all lending has to be affordable. Well, immediately, if you think that through, if you've got two home loans and you can't afford, under the bank's criteria to afford two home loans, then they are now forced to decline that application because at the time of the application, all lending is no longer affordable. So the actual true sense of a bridging loan isn't really a thing anymore, and it hasn't been a thing for a long time. If you can afford both loans at once, then you're not getting a bridging loan, you're just getting a loan because you can afford both loans at once, right?
Yeah.
And then just to put a little bit of confusion in what I've just said, there's something called a closed bridging loan, and that's only possible when the house you're selling is unconditional and the house you're buying is unconditional, so the bank know the two dates and they go round the wrong way. And what I mean by that is you buy the new house before you can sell the new house, then they will do a bridging loan in that instance only because they know both sides of the equation are unconditional and they know the settlement dates of that bridging loan. After saying that, they won't sort of bridge for any longer than maybe 2 weeks. So it's not like one of those old bridging loans, I have a bridging loan for 4 months, They would like to see those dates, even though they round the wrong way, to be no more than really 2 weeks, and then it all sorts each other out and the deposit funds can be placed against the new purchase by selling the old house. So that's quite a detailed little explanation there. And look, if anyone watching, of course, wants more detail around that, I'd encourage them to give me a call because we're sort of getting right into the weeds now and something that's a bit more technical than just deposit funds for a first home.
Yeah, but still very helpful because I imagine, imagine it'd be a small percentage of people in that situation, but quite a crucial, piece of information, for someone like yourself to help work that process through so they can get what they want.
And unfortunately, that phrase bridging loan, it's still bouncing around out there. And, the misconception, I'll just get a bridging loan. And
right.
can be a bit of a difficult conversation sometimes.
Yes. Yeah, I imagine. One question I had on the KiwiSaver side of things. So you mentioned how KiwiSaver works. If you've got two parties, just say a couple buying their first home, they've both got a KiwiSaver fund that they've saved up. Say one's got 50 grand, one's got 100 grand or whatever, or 50-50. Can they both use their KiwiSaver towards buying that home together as joint owners?
Yeah, and again, there's some nuances. Absolutely is the answer. Yes, you can. Right?
Yeah, right.
If one decides not to use their KiwiSaver, though, then they've sort of locked themselves out of ever being able to use their KiwiSaver to buy a house because they've now owned a house. And one of the rules of KiwiSaver says that you've owned a house, so you can't use your KiwiSaver unless it's a marital bull split or for an influence outside of your control forced you to sell the house. So a lot of people sort of think, with our second house purchase, we'll use the other person's KiwiSaver.
Yeah.
And you'll say, well, no, you can't because you've previously owned a house.
That's interesting.
You've got to watch yourself there, right? Because then you'll only have access to your KiwiSaver funds at the time of retirement. Or unfortunately, if you happen to have a separation with your partner at the time, and then you might get under the second chance, a chance to use it again because you didn't use it the first time. But of course, you don't go into a relationship with the idea of splitting up. No. So that's, So an interesting question there. And there's a few little nuances, but yeah, look. The other one is that a couple have got together. One person's already used their KiwiSaver to buy a house. They've sold that house and now they're looking to buy again. The other person hasn't purchased a house and has KiwiSaver. By having this person over here does not stop the person that has not owned a house before to use their KiwiSaver.
Right. That's what happened in my relationship.
Yeah, right.
Is that I'd owned a house within a previous relationship. And then, my current relationship, she could use her KiwiSaver
100%.
towards the home we bought together. And I found that was quite interesting. So that's another scenario that can play out. Wow. Yeah, brilliant.
I mean, the ticket there is, or the trick to it is, if it's your first home and you've got KiwiSaver, despite what anyone else is doing in relation to ownership, you can still use your KiwiSaver.
Yeah. Brilliant. Yeah. Well, I mean, that's awesome information as well. And so if someone was to, reach out to you, and how the heck do you sift through their situation and kind of, work through all of that information to find the best result for them? Like, because there's so many different things can be going on in people's lives,
100%. And there's, I suppose, the experience of doing it as done it as long as I have, is that some catch points where I have to know this piece of information to know which direction I then go with the next part of the conversation. So there's some very key information that I get to know very quickly to say, okay, we're actually going down this path to get to our goal.
Right.
Where if the answer had changed, then we'd have to go this way to get to our goal. So it's in depth and there's a lot to it, and sometimes that surprises people on the depth of information that's required to get to, having finance approved. But equally, we try and make it fun. We try and make it as light-hearted as we can, without it being too boring, all about finance. And that's why we bring it across with, the things behind me and things, just to try to make it a little different.
Yeah, brilliant. Awesome, Scott. Well, look, if someone's listening to the podcast today and they want to get in touch with you and have an appointment with you, my understanding is that your service is free.
That's right. Yeah, we don't charge for our services. The bank pay us a commission once the loan's settled, and that's not added to the applicant's repayments. It's not added to the interest rate that we secure for the applicant. It just comes out of the bank's overall profit model. So the service is completely free to our customers.
Fantastic. And we'll obviously have the website link after this here, but what's your sort of preferred way that someone reaches out to you or your team?
There's a lot of information on the website, and if you feel like you're the investigative type of person and want to find out a few things, then there's loads of information on there. There's contact forms, first home buyer forms, first home buyer guides. There's all sorts of things on the website, and that would allow you to get hold of me or one of the other brokers here at Advanced Mortgage Solutions.
Brilliant. All right, Scott, thanks for sharing your wealth of information with us, and thanks everybody that's listening. We'll see you on the next episode.